All right, good evening, good afternoon, everybody. Thank you for joining us for today's presentation. There's still some people that are coming in, so I'll be admitting everyone who's joining us as they are able to join. So once again, this is a presentation. We're Innovative Wealth Building. We're happy to have you all, a pretty good turnout, almost 40 participants. So we're happy to have everyone join us. Today's presentation is going to be all about Social Security, and we're going to uncover how annuities can really play an important role in your overall retirement plan. Just to get started, we always have to have a disclaimer slide. We're not selling anything. We're not pushing any types of products. We're really just here to educate you, to give you more information about how to make the best selection for your Social Security, and also just giving some more deep dive, uncovering some more data on how to make the right selection, and then also talking a little bit more high level about how annuities really play a big role and can play a big role in your retirement plan. But once again, just here to give education, not giving any specific advice, as everyone's situation is very different and it really just depends on your unique specific financial situation. So like I said, questions will be allowed at the end, but we won't answer anything too specific because we don't want to give advice without having further information. So we're going to go ahead and kick it off today. I'll be doing the first half. My name is Kenna Parham. My hair color is very different. I actually went a little more red, so I don't look the same as that picture. I'm going to update my headshot soon. But my name is Kenna Parham. My husband, Terry Parham, and business partner will be doing the last half of the presentation. We're your speakers for today. We are both the co-founder, two of the four co-founders of Innovative Wealth Building. We are located in the Los Angeles, California area, and we're happy to be talking about today's topics today. So just to give you a little insight on who we are, some of you guys are already clients of ours, others might not be, and may have just heard about this presentation on our social media. We have a pretty big advisor team. So Terry and I are the co-founders, with Jennifer Hill and Warren Brooks being the other two in the California, Maryland office. And then we have Coy Baldwin here, Carmen Kubanda, and then we also have Ellen Knipe. So we have a pretty big, robust team. The two of us are in Los Angeles, and then the other four are in the California, Maryland office. And then Carmen Kubanda is actually serving Fort Worth, Dallas, Texas area. So if any of you are in Dallas, Texas and need someone to talk to, Carmen's your guy. And same with Coy and Ellen being in California, Maryland. So we're happy to be here to present some good information today. And we'll go ahead and continue forward on the agenda. If some of you aren't clients, our main mission and goal here is really just to collaborate with people to help them build and pursue really the best financial life that they can have for themselves. So the ultimate goal is to always collaborate first, educate, have people feel empowered about their situation, and then give them the best knowledge that they can have to move forward to make the right decisions for themselves financially, and to ultimately feel like they're in control and they're in the driver's seat, but they're having that partnership to truly help them make the best financial life for themselves. And a big part of that is education. So we love to put on these webinars, hopefully be putting them on every month on various different topics to really help people feel like they're able to find the right type of information out there. Google can be very overwhelming. There can be so much misinformation, or hard to take the information and know how to apply it to your specific scenario. And so it's important to be able to have a trusted source to get some good information and actually learn how to apply it to what you're looking for. So let's go ahead and get started in the agenda. We'll jump right in. Like I said, we're talking about Social Security. This is definitely a hot topic, whether you're near retirement or far. I think it's important for everybody to be aware of Social Security and how it does play an overall role in your financial plan now and in retirement. So we'll talk about the Social Security basics. We'll do kind of a deep dive into spousal and survivor benefits and how that can impact your decision. Some common pitfalls that people run into when considering to make their decision or looking at their benefit. And then overall, just tying it together on how to fully maximize your benefit and get the most out of it. This is a benefit, everybody's paying into it, like they're putting money into their 401k. A pretty large percentage goes into your Social Security paycheck from your paycheck. So it's very important to know like what that benefit's going to do for you and how you can really maximize that in retirement. And then, like I said, we'll wrap it up at the end talking about annuity basics. So just what is an annuity? What are the different types? Why does that vehicle make sense for some people? And how does that vehicle kind of come together alongside the other parts of your financial plan? And we'll really be honest and be transparent about what are the pros and what really are the cons. Like not every product makes sense for everybody. It's very specific to the right person and what they're looking for. And then Terry will go ahead and summarize and wrap everything up and put a pretty bow on it. So I'm going to go ahead and jump right in to some Social Security basics. So I'm sure a lot of people, know a basic amount of information about Social Security in general, but we're going to start off with just how does your Social Security benefit get calculated and what is the eligibility for it? So the way that it gets calculated and the eligibility is it's the 40, 35, 40. So this is like a good thing to remember when it comes to how is my benefit calculated and how am I eligible. So you have to have 40 quarters of work history, essentially. So they have these different ways of calculating like so it comes out to about 10 years of work history, and then they take your top 35 best years. So you have 35 years that are your top highest earning years. And you earn quarters through the years. People who are just getting started out, working a couple years here and there, you earn quarters. And then once you get the 40, then they take your top average of your best highest earning years, the 35, and that will be what your benefit will be. So it's basically some calculation that Social Security has. And oftentimes people will have like an excellent 35 top, highest earning, and they'll benefit will definitely fall in the higher span of things. Some people have years where they're taking care of children and they're working inside the home. And so they might have a 0 on that work history, where maybe for 3 to 4 years, they don't have any earned income that's classified under Social Security. And so what that does is that can actually bring your average down. So that's why oftentimes people will say, well, why is my benefit less than that person's when I did work for 40 years or I did work for 35 or 30? Well, if somebody didn't ever take a year off, their benefit will be higher because it's taking your highest average. Now, this number here, 40, is interesting. So Social Security basically says 40, your Social Security benefit should replace 40% of your salary, essentially in retirement. Now, what they base that off of is an average salary. So in 2024, the average annual salary nationwide is about $60,000. So they're saying that Social Security benefit should replace about 40% of that. Now, that might be correct for some people, right, for the average salary. But if you're more in the top higher earning income bracket, that's not going to be the case for you. And so it's important to understand that that's why there's an asterisk there, that it may not, and it probably won't replace 40% of the total needed income that you will have in retirement. It may be more like 15% or 20%. So when planning for retirement, it's really important to understand what percentage of that Social Security benefit, whether it's just me and my spouse together, or it's just me, is going to make up my total need in retirement. So it's definitely a good thing to understand and try to solve for yourself to see like how else am I going to make up those extra dollars, whether it's a pension, whether it's retirement, savings like 401k, IRAs, things like that. But the average person, maybe it'll be 40%, but for people that have been earning and that have high earning income years, it probably won't be just 40%. So let's go ahead and talk about one of the most important things, which is full retirement age. So your full retirement age is essentially going to be like 100% where you can get the max amount of your benefit. So everyone's full retirement age is a little different. If your birthday, it falls between 1943 and 1954, your full retirement age will be 66. If you, as the years go on, 55, 56, they add 2 months, which is kind of interesting. And then for a lot of people, 1960 and later, the full retirement age will just be 67. So they kind of were like, okay, let's not overcomplicate this and add it by 2, 4, and 6 months. Let's just say 6, 7 years old from 1960 and later. Keep it simple. So that's what they decided to do. So if you take a look at your statement, it'll tell you what your full retirement age is on the statement, but it's definitely based off of your birth year. So like I said, the full retirement age, to take full retirement age or to not. So that's the biggest question I think a lot of people are really trying to consider and weigh out their options. Should I take Social Security at 62? Because 62 is the first age that you can take Social Security. That's when you can elect for your benefit. A lot of times people are just ready to elect and they don't want to wait, but there are definitely some benefits and some pros to waiting that are really, really important to consider. So for full retirement age at 66 and 2 months, or if yours is just plain 67, that's when you can get 100% of your benefit. So if you can wait until that full retirement age, you can max out your benefit at 100% and walk away with knowing that, hey, I didn't, I had 100% of my benefit and I'm good. Now, like I said, Social Security, you're eligible to take at 62. So that's the first age you're eligible to take it. But the problem with taking that for some people is that, and for everybody really, but for some people that are like, hey, I just want to take it at 62. Like I've been paying into this for 35 years. I just care about getting a benefit. They will want to consider that it will lead to a 30% reduction. So if you do, if you don't want to delay, another few years, you are going to be basically walking away with a 30% reduction in benefits. So it's definitely something to consider, to actually think about, like, how much more money would that be for me from 62 to full retirement age 67? Am I still going to work? What is my salary going to be? Do I need my benefit at this time? Do I have a health condition where, I feel like I'm not going to live very long, or do I have family history where I feel like I'm not going to live very long? There's many factors to consider when it comes to taking a benefit earlier versus later. But if it's really down to the financial aspect and you're saying, hey, I want to maximize as much as I can, knowing that you could walk away with a 30% reduction is important to consider. And so I think everyone should understand that that's definitely, a drastic difference. Now, on the other side, like I said, at full retirement age, you can get 100% of your benefit. Now, if you wait even longer, the longest you can wait to take your Social Security benefit is age 70, which a lot of times people are really working up until, 65, 68. Some people are really happy in their career and they love what they do, and they're going to continue to work for a long time. So maybe income and a need to have to live off of retirement assets or Social Security is not that high for them. So oftentimes people will say, hey, let's just see how long I can go until I need to take an elect for my benefit. So at age 70, if you do wait all the way from 66 and 2 months or 67 all the way to 70, you could get 132% of your benefit. You can max it out over 100%. So you could get an extra 32% increase by waiting all the way to 70. Now, some people will say, well, I don't want to wait till 70, but I could wait till 68. Well, each year from your full retirement age until you hit 70, it's an extra 8%. So you will get an extra 8% if you just wait 1 year or 2 years. You don't have to wait all the way until age 70, but waiting an extra year does make a difference. So it'll show you on your benefit what that will look like, but it's very important to understand the benefits, the pros and the cons to waiting, and what that would look like, or the pros and the cons to taking it at full retirement age or taking it at age 62. So if you take a look at this example here, this would be somebody's benefit at taking at 62, that's $1,750, versus taking it at full retirement age at 66 and 2 months, 6 months, or 67, and then taking it all the way at age 70. So there's definitely a pretty significant difference if you take a look at taking it as early as possible at 62, which would be a $1,750 a month benefit, or you could wait until 70 and take it at age 70, which is $3,300 a month. So that's very significant, and it does make a big difference, and it really can impact your retirement long term, especially if you're like, hey, I'm planning for a long retirement. I'm feeling good about, I'm going to live long and I want to maximize as much as I can. Just knowing the dollar figure of this is really powerful and important, because it's in our control to know when to elect. So this is important to see just from a numbers perspective, how different it can be. Even getting, an extra $500 to $800 a month is very significant in retirement. So that's definitely something to consider and weigh out as you take a look at your benefit. There is something interesting called, it's not really a bonus, but we're calling it the Social Security bonus. It's not really heavily advertised on Social Security website. They don't really talk about it, but it is some sort of a benefit where what people can do is they can say, hey, I'm ready to elect for my Social Security like today. So instead of electing what their benefit would be today, they would basically put their application in online and they would backdate it 6 months prior. And what that does is it allows people to actually receive something like a lump sum from Social Security. So basically you can elect to backdate it 6 months prior. They would give you, let's say, $15,000 to $20,000 as a lump sum. It'll vary based off of your benefit and your specific scenario. And they'll say, hey, since we gave you a back payment of XYZ, $20,000, we're now going to decrease your benefit by $100 a month, 150 or 200, but you would receive that lump sum for backdating at 6 months. So this could be important for somebody who, wants to pay off something, like they want to pay off a car, or they want to put, like a pretty big chunk on their home. Let's say they owe, $50,000 or $40,000 on their home. And they're like, hey, I really want to pay that off. But I just, with my current position and my current assets and my cash, I don't want to take anything out of my retirement. That could mean a lot to somebody to have an extra $20,000 to drop on their mortgage and be okay with taking a lesser payment for that forever. So it does actually decrease your payment moving forward forever for the life of the Social Security payment. But it gives you that out-of-pocket $20,000 or whatever the number would be for you. So it's something to consider. And if you have specific questions about it, you can reach out to one of the advisors and we can help you. But we've actually walked people through this process before, and we've seen them receive the back payment. We've seen them apply for it and it work out perfectly for them. So it's not for everybody. It's very specific to your scenario and what you want. If that lump sum makes sense to you, it's a great benefit by Social Security that could be a good option to consider. So this is the grand old Social Security statement that everybody loves to see. If you haven't created an account online, you can go on ssa.gov, create an account, and you'll have a benefit statement, especially if you have enough quarters of work history for them to produce it. And it's a great statement that really shows, your full benefit from 62 all the way to 70. So it's going to show you the projected numbers here on the top right hand of the screen. And it'll show you, like, really, if you waited till 66 or 67, like some people are specific on the year that they plan to retire, and it may not fall in line with the first time you can elect or the latest that you can take it. So if you're like, hey, I really want to retire at 65, it'll show you your exact benefit. It also will talk through, your disability benefit as well, if that's somebody's specific situation. And then it'll really show like survivor benefits as well. So this is just a great statement that shows everything regarding your work history and what your benefit will be on a monthly amount. So if you haven't already pulled this, I would pull it and take a look. And then if you have any questions, one of us can definitely help and answer any questions that you have about it. So we're going to now move into survivor and spousal benefits and talk a little bit further about each of these. So spousal benefit is very important. And I think sometimes people are a little bit confused on what it actually means to have a spousal benefit available to them. So there's definitely some eligibility. You already have to be married, of course. You can't be with someone and, not officially be married and then try to claim their benefits. We've had that situation before where people are like, hey, we've been with somebody for X amount of years, we're basically married. Unfortunately, Social Security is like, you have to legally be married to be able to be eligible to have the spousal benefit. The spouse claiming the benefit must be at least 62. So you can't claim the benefit at 55 or 60. You definitely have to be at least of eligibility age. And where this is super helpful is, let's say somebody was like, hey, I worked in the home and I took care of kids and I only worked for like 10, 15 years. My benefit won't be very much. So let's say that if they were to claim their benefit at 62, it would be, $600 or $700. Whereas what they could do is they could take 50% of their spousal benefit, and that would be higher than theirs. So that's a situation where it's really good to understand where the spousal benefit can play and the value that it can have, where it can give you more money. Essentially, like if you take half of your spouse's benefit and it's higher than your benefit, then hey, that's an important thing, and that could give you more money. The other eligibility factor is that your other spouse, they must be already receiving benefits. So you have to wait until they were receiving it to take the benefit. And there's also one other benefit as well, where people who have been married to somebody for at least 10 years, they can actually take their spouse, their ex's benefit. They can take 50% of their ex's benefit as long as they were married for 10 years and as long as they're currently still unmarried and they're not remarried to somebody else. So if you're someone that's been in a situation where you were married for, at least over 10 years, and your benefit's lower than what your partner was, then you could actually take a look at their benefit and say, hey, I'm going to just claim off of theirs because I'm currently still unmarried and that's going to give me more money. So whatever is going to give you the biggest amount and the biggest benefit is really the ticket. And it's nice that they have this benefit available to people who may have been married prior, that want to see if they can claim off of their ex-spouse's benefit. So like I said, the spouse can receive up to 50%. of the higher earning spouse's full retirement age benefit, the amount is lower if benefits are claimed before full retirement age. So if the spouse that you're trying to claim off of takes it at 62, your benefit will be lower. Now, if they claim it at 67 and you're ready to take it, then it'll be higher. And if they wait till 70 to claim it, it'll be even higher. So it's just, it all depends on when your spouse claims. So it's really important to try to correlate that decision where if you are going to, if you are with your spouse and, you guys are planning for your retirement, you probably want them to wait a little bit longer so that your benefit will ultimately be higher as well. So it really benefits both of you, for both of you to wait. And then on top of the spousal benefits, there are survivor benefits as well. So the survivor benefit is where a widow or a widower can receive up to 100% of the deceased spouse benefit. And it really depends on age and what the deceased spouse benefit was. So Social Security, if your partner or someone that you were with, if they passed away before full retirement age and you have children in the home, you will receive some sort of benefit. It's some calculation that Social Security will do that takes their work history and they put the calculation and they'll tell you exactly what your spouse's benefit will be for survivor. And you'll get some of that benefit while you're taking care of your children and raising them as well. So let's move on to like full on survivorship and what that looks like. So if you're somebody that, has survived someone that has passed away,
We lost you.
Yep, I've lost them too.
Hello, everybody. Just give them a second. They'll get connected to their hotspot and they'll be back on.
Okay.
Thank you.
can everybody hear me okay?
Yes, we can now.
Yes,
All right.
yes, we hear you.
Yes,
Thank
now we
you.
have you.
My internet decided to fully just blank out on me in the middle of me talking. I saw my little light on my camera go off. So I was like, uh-oh. So I was able to reconnect. I'm going to go ahead and share my screen and then get back going on the presentation. So give me 1 second. There's other people trying to enter the room.
Ken, are we still recording also?
Yeah, we are. It said it right when I logged back in.
Okay, great.
Yeah, it's still recording. So sorry about the technical difficulties, everybody. All right, I think we're back in business. All right, let me make that. Okay, perfect. All right, thanks everyone for being patient there. So just to wrap survivorship, if you're somebody that has a spouse that's passed away, you are eligible for benefit starting at age 60, and it really just depends on when they passed and your specific situation. But the benefit will be available to you. There are children benefits as well for minors, but they have to be at least under 18 to receive those. And those are all on your statement, as well as Social Security can explain the benefits a bit further for your specific benefit. But the last thing I want to mention is there is some one-time benefit that's a death benefit for Social Security, and it's a non-taxable $255 benefit that's paid to the surviving spouse. So Social Security is like, hey, here's this amazing one-time non-taxable little, benefit for you. So that is another added feature, not super big at all by any means, but it is something that somebody would receive. So if you have any specific questions about your survivorship scenario, we have had people we work with in the past where Social Security have told them something different than what they thought, and we kind of helped correct that, and we're able to help them get the correct benefit that they needed to get based off of a survivorship situation. So if you have any specific scenarios, we'd be happy to help offline, but that's really how survivorship, or how it works with Social Security. So Terry's going to take it away with common pitfalls and then take us through the rest of Social Security, as well as shed some light on annuities. So I'll let him go ahead and take it from here.
Thank you. You could have just slid your chair and I slide mine in like bumper cars. Hey, everybody. If you don't know, I'm shorter than Kenna, so I had to adjust the camera a little bit. Just going to make sure that our share is working correctly. So give me just a minute. I'm going to stop the share and then reshare the screen just to ensure that we are on the right page, because we have lots of different screens. So just a quick sanity check. Is it now full screen? If someone can tell me in the chat box.
Yes,
Or-
it's full screen.
Yes.
Good.
Awesome. Thank you so much. So thank you, Kenna. That will be a hard act to follow, but I'll do my best and fail forward. So speaking of fails, let's talk about common pitfalls with Social Security. We don't tend to say that there's bad decisions financially. However, we hear people tell us of certain things that maybe could have gone better or that they wish wouldn't have happened. So here are just a few of the common pitfalls that we see. One of them is claiming benefits early just because. There's lots of good reasons why a person should claim their Social Security benefit early. Maybe they become disabled, maybe they need the money to survive or to make ends meet. There's a ton of reasons why it might be appropriate to claim early. However, claiming early just because, maybe not the best choice. That might almost be like showing up at Target at 7 a.m. when it doesn't open until 8 a.m. Doesn't really serve you that well. Yes, that was me this morning attempting to get a present because my 3-year-old had a birthday party at school today, and he has to give presents to every little kid. So again, to claim early just because, maybe not the best choice. Lots of reasons why. One of them is published by the Social Security Administration every year, and it comes down to the earnings limits. So if you Google it, earnings limit Social Security, you'll find out that starting at 62, if you claim Social Security, the Social Security Administration does not want you to work and make much money. If you do, the benefit amount that you'll get is reduced. So let's say you take Social Security at 62 and you're making more than $22,320 a year, or better stated, $1,860 a month. They're going to penalize you. Every $2 you make above that amount, you're going to lose $1 of your Social Security benefit. So let's just say you have an $80,000 job. You claim Social Security at 62. Congratulations, your whole benefit's gone and you get nothing. Now, in fairness, they're going to put that money back into the benefit computation. You'll get it later. But what's the point of claiming at 62 if they take all the money and you don't get it anyways? So very important to be aware of the earnings limits. Again, it's under $2,000 a month, the amount that you're able to earn from work. As you get closer to FRA, or full retirement age, you can make more money, but it's still somewhat modest. It's about $59,520 a year. Now, in the year that you turn full retirement age, they only take $1 for every $3 you make above that amount. But the bottom line is, if you claim Social Security before full retirement age, you might have a benefit reduction based off of your earnings. People always ask, well, what if I get to full retirement age? What happens then? Make as much money as you want. They don't care. There's no reductions once you reach age 66, 66 and 6 months, 67, whatever the age is based off of your year of birth. The next pitfall is just not understanding Social Security taxation. Sometimes I ask people, if you could choose, how much of your Social Security would you want to pay taxes on? And the answer, probably nothing, right? The good news is paying 0% on your Social Security is completely possible and it's legal. The way Social Security works is something called provisional income. Based off of your provisional income, 0% of your Social Security might be federally taxable, 50% will be federally taxable, or 85% of it is federally taxable. I say that because in some states, Social Security is not taxed at all. So let's look at a married couple, and let's say that their provisional income is below $32,000. If that's you and your spouse, you pay 0% tax on your Social Security. So what is provisional income? It's basically half of your collective Social Securities, and then any other type of income put on top of that. So if there's a couple living off of $60,000 a year of Social Security, and they have no other income, they pay 0% taxes on their Social Security. Not a bad deal. And that makes a big difference because if you retire, depending on when you spend down certain assets, it might be possible to live tax-free for 1, 2, 5, 8 years, depending on the numbers. So if you've never heard of that, chat with your advisor and figure out how you can potentially have some tax-free years as you transition to retirement. Sometimes I just put really dumb stuff on slides just because. This is a live look at the Los Angeles Social Security Administration office. Just kidding, the line's probably longer here in LA, but we've heard horror stories of people trying to get appointments, sitting on hold for hours, submitting their paperwork and then waiting 8, 10, 100 weeks in order to get their Social Security payment. What I would say is, don't wait. If you want to start getting your Social Security paid to you on May 1st, you should have already submitted that 2 months ago. When you do claim your Social Security, you can backwards date 6 months, as Kenna told you, but you can also forward date. So let's say you go online and claim today. You could claim to have it start May 1st and just put the paperwork in today instead of waiting to May 1st to click the button. So the point of this slide, again, don't make the mistake of waiting to file for Social Security and thinking it's going to show up in your bank account in 48 hours. The Social Security Administration does not operate on the Ethereum or Bitcoin networks. I can assure you, you'll be disappointed in how long your application sits somewhere on a desk and then eventually gets processed. There's the saying, there's no I in team, but there's a me in team. Whenever you're making a Social Security decision, if it's not just you, we would say consider both parties. We don't just want to choose the option that's best for you or best for someone else. We want to choose the options in a coordinated fashion that work best for the family unit, in the case that there is a family unit. Ken, I mentioned earlier, with survivor benefits and spousal benefits and all these nuances, Social Security is one of the biggest choices you'll ever make for guaranteed lifetime income. So you want to get it right. Think about this. If a couple has $5,000 a month of Social Security income, how big of a lump sum would they have needed in their investments in order to give them $5,000 a month? I'm going to actually pause and see if anybody knows that answer. So let me state this again. In order to get $5,000 a month that lasts forever, how big of a lump sum do you need? So let's see if anybody knows the answer to this. I'll wait just a second. I'm looking in the chat box. And the reason I'm asking this question is because that's how important Social Security is as a decision. It's truly a multi-million-dollar decision. So I see 500,000, 800,000, 1 million. The answer is about $1.5 million. If you think about safe retirement income, there's something called the 4% rule. And the 4% rule states that if you take a lump sum, draw down 4%, pretty good chance it'll last forever. So by using the 4% rule, we can calculate that a family unit Social Security benefit is probably more than $1 million decision. So you want to approach it as such to make the best choice. Don't end up like this fool here on the slide. You don't want to be this guy if my slide moves forward like it's supposed to. So you don't want to be the not team player. We want to be the team player that helps us come up with the best outcomes for yourself and the ones that you care about. All right, so let's move on to the good news, which is how to maximize your benefits. Lots of ways you can do it. We're going to just hit a few of the simple ones. So number one, it's just to consider delaying. This isn't rock science or rocket science or really any type of science. It just comes down to the numbers. And when you pull your statement, it's plain as day. If you take Social Security at 62, you get $19.92 a month. If you wait, it gets bigger and bigger and bigger and bigger. So think about the work that you do right now. If your employer said, if you stick with us one more year, we'll give you an 8% pay raise, what would you say? If the answer is yes, maybe think of your Social Security the same way. Because every year you wait, you're getting about 8% more. And it's not just every year, every single month, you actually get a little bit more. Yes, it's only 5/9 of 1% or 5/12, depending on your specific situation, but that's more money every single month that you wait. So really important to, again, measure once, twice, 3 times, and then cut with the best decision. When you do consider the delay, again, it's not just the monthly amount, but it has a lifetime of impact. In our scenario, we can say a person 62, Andrea here, if she claims Social Security at 62, she would have had about $1 million. But if she waits until 70, she would have had about $1.4 million. So 40% more money just from Social Security. What's important here is life expectancy. None of us know how long we're going to live, but there's indicators. Personally, there's indicators. How's your nutrition? How's your activity? How's your family history? And then we can just look at the math and science of the people that have come before us. And in most situations, if you're going to live until at least age 81, you're better off waiting to claim Social Security at almost any time frame. So again, if you want to plan on a long retirement, shake the little 8-ball thing. We used to all have that. It says the outlook is good to delay your Social Security claim. Cola. I don't know if there's any Pepsi fans out there, but we're going to give a shout out to Coca-Cola. We're not endorsed. They don't give us any money. It's really just, picture to take up space. But the cola is the cost of living that you get every year, hopefully, on your Social Security. Now, granted, there were some years where it was 0 or it was abysmal, let's say 0.5%. But 2022, 2023, 2024, 6, 9, 3% increases in your monthly paycheck. Again, the reason that it's important to delay is the more you delay, the bigger your Social Security check. So then there's a bigger number that the COLA is being applied to. So it's a little bit more money every single year, compounding and compounding and compounding. So sometimes people just say, oh, 62 versus 65 is only $500. Well, that's today. The next year it's $500 plus the COLA. And then the next year it's $500 plus the COLA plus the COLA. And then and so on and so on and so on as long as you live. So again, keep that in mind. It may be sensible to delay because of the higher payment amount, the higher COLAs, and how that helps you the longer you live in retirement. Going to quickly hit on a couple best practices. Again, there's 1,000 variations and iterations of how to figure out the best option for you. We had one client where she was younger than her spouse. And what we helped her figure out that she could do was she could claim her benefit now, take advantage of years of receiving her paycheck. And then when her husband claims later, she'd actually get a bump up to the spousal benefit, which was actually higher than the amount she already had. So she didn't know. She thought she had to wait until he claimed to claim spousal. We said spousal is going to give you more money, but if you want the free lunch money now until the bigger number comes, go to Social Security, click that button now. Oh, by the way, backdate it 6 months because you're going to flip to the new benefit anyways, and that reduction of $50 a month won't really even matter. So that's one scenario where depending on the age gap between spouses, depending on their benefit gap, some planning could really put money into your pocket. Another scenario is just in the instance of survivorship or not. You can take it, the survivor benefit at 60. You can wait and take your own at 62. And then you can switch from one benefit to the next. There's all these different factors. The best choice for us is whatever works best for you. And the only way that we know that is by diving deep into the numbers and running some analysis. So I would just say, for the best outcomes, let's get specific and make sure that you're on the right path. So that's all we have for Social Security. We have 15 minutes remaining. I talk too much and I talk too slow. So I'm going to have to make sure we kind of blast through these slides to hopefully leave some time at the end for questions. The overarching theme, annuities can be a really valuable tool for a secure retirement. Annuities aren't for everybody. Annuities aren't perfect in every situation. But for many people, it can be a good tool to have in the toolbox. So what is an annuity? At its most basic level, it's a contract between you and the insurance company. That insurance company is going to make you certain promises, and they're legally compelled to stick to those promises. Often, those promises allow them to take risk from you and offer you something valuable in return. So we'll talk about the different types of annuities. There's fixed, index, variable, deferred, and immediate. Think of these as lots of different vehicles that may be appropriate for you or not, depending on your situation. So a fixed annuity is something like a CD. You can buy an annuity where the annuity company will say, give us $100,000 and we'll guarantee you a 5.5% return for the next 5 years. Some people like the sound of that because right now CDs are not 5.5% and they're surely not 5.5% for 5 years. So a fixed CD is an opportunity to get a fixed rate, a guaranteed return, and lock it in for 3 years or 5 years, sometimes longer. It's that simple. That's how a fixed annuity works. An indexed annuity gives you the opportunity to experience market growth with none of the downside. So an index annuity might say, hey, we're going to give you 50% of whatever the S&P 500 returns, which is the general US stock market, but we're not going to give you any of the downside. So for the next year, we're guaranteeing that you're going to earn somewhere between 0% and half of what the market does. The market does 20, you get 10%. The market does negative 20, you get the 0. Again, some people are happy to take a part of the upside if they're protected from any of the downside. Lastly would be a variable annuity. A variable annuity, it does this. It's almost like investing in the general stock market, but the only difference is variable annuities can also have certain features built on that are guaranteed. So with variable annuities, there's a guaranteed portion and a non-guaranteed portion. These are typically the most complex annuities. Depending on the economic factors, fixed, index, variable, they kind of switch back and forth between, who's head of the classroom. But again, variable annuities, out of all annuities, have the most risk. They typically have the most fees, but they offer you the most growth potential. The last two nuances is to either have a deferred annuity or an immediate annuity. A deferred annuity means I put my money in it, and I'm not going to touch my money for at least 1 year. So 1 year, 5 years, 10 years, whatever, that's a deferred annuity. An immediate annuity means I put my money into this product and I'm going to start getting something immediately. So Terry drops $100,000 into an immediate annuity, and then he immediately starts getting monthly paychecks, $600-700 a month, and that paycheck lasts for as long as I live. So that's just a quick and dirty of the different types of annuities. Again, depending on your situations, your risk sensitivities, your goals, one or the other may make sense as a part of a broad diversified strategy. The purpose of annuities comes down to two things: income or growth. If we think about Social Security is probably considered a good thing. It's a lifetime paycheck that shows up forever as long as you live. That's the same thing an annuity does. Social Security is literally an annuity. So you've got to ask yourself, if you could take a chunk of money and give it to the Social Security Administration to get a bigger pension, would you? Because if that sounds you can pretty much do that by just taking money and giving it to an annuity company. Now, the big difference is the annuity companies don't control taxes. They're not funded by, payroll taxes, but there are lots of protections in place to make sure that paycheck continues as long as you live. Growth, we talked about this earlier. With annuities, they're some of the only investment products where you can be guaranteed against loss. There's lots of variations. There's lots of different ways you can use annuities. But at the end of the day, the purpose is either to give you income, which is a monthly check you can spend, or to give you growth with some protections, be that downside protection or something to that effect. So to summarize again, the annuity advantages: safety of principal, options for protected growth, and then guaranteed lifetime income. Annuity disadvantages: they're sometimes unfamiliar, they're sometimes complex, they're usually less liquid, and they can have surrender fees. So liquidity is just a measure of how quickly you can put money into a product and take it back out. So when you put money into an annuity, often there's a time where you've got to wait to be able to take out all the money. Much like a CD. If you buy a 3-year CD, if you take it out before 3 years, there's a penalty. Annuities work that same way. And that's what the surrender fee is. It's the charge for you leaving the annuity too early. That said, most annuities have something called a free withdrawal. Again, you put in 100,000 bucks, you can take out 10% every year without any penalty. In most situations, a client or an investor is not taking 10% out of their investment account every year anyways, or else they're going to deplete their portfolio, because that's way more than the suggested 4% you would take out for the safe withdrawal rate rule. Again, pros and cons. There are some use cases where maybe it would be advantageous. So just a few questions to consider, and then we're going to land this plane. Think about your current investment balance. 100 bucks, 100,000, $1 million. What is that investment balance going to be on day one of your retirement? Could be higher, could be lower. If you're worried about that, maybe an annuity is a good fit for a portion of your funds, especially if it's a portion of your funds you plan to spend as soon as you retire, so the rest of your money has more time to grow. So one question to think about. Let's say you have $1 million invested. If you're following the 4% rule, year one, you spend 40,000 bucks. But what if your portfolio drops to 850,000 because of a market downturn? You probably still want that 40,000, but are you willing to take more than the 4%? Again, this is one of the use cases where with an annuity, doesn't matter. There's no loss of principal. So you'd be able to confidently take that same $40,000 a year or have that guaranteed paycheck. The last thing that we help people figure out through retirement planning is, are you already on time? So let's say you're going to the movies. If you have plenty of time to get there, there's no need to rush. You don't have to drive 105 miles an hour on the highway. Go the speed limit or 7 miles above, and you're going to be just fine. Conversely, if you've got way more than enough time, then you can be judicious with how you get there. You don't necessarily have to jump from lane to lane. It just allows you to have a smoother ride and taking less unnecessary risk, because why take the risk if you don't have to? So we like to know where you are in regards to accomplishing your retirement goal. If you're ahead of schedule, maybe we don't need to take unnecessary risk. So these are all the things we think about as we build a balanced strategy. So this was specifically about annuities. Obviously, that's one tool out of lots of tools. But we always share this with people because there's a lot of misinformation and honestly just a lack of experience on this topic. So if you'd like to see sample illustrations about growth or income producing annuities, if you have an existing annuity that you just don't understand, we have a 50-point annuity review checklist we can help you with. If you just don't know how you want to take your nest egg and turn it into spendable money, we do have something called the RISA, the Retirement Income Style Assessment. It's like 15 minutes long, but it will tell you what type of investor you are as it pertains to taking the nest egg and finally spending it. So if you want more annuity talk, let us know. Again, our 7 advisors are happy to help however we can. Woo! In summary, whenever Kenna and I do these presentations, we feel like we're just giving gifts of knowledge, gifts of money, gifts of wealth. But we recognize that sometimes it feels more like a gift of old furniture strapped to the back of a bicycle. Like, this is a lot, it's hard. So let us be there to help you with the heavy lifting, if that's something you're open to. Many of our great clients are there on this line already. If we haven't had the opportunity to provide any value or to help you to this point, that's what we're here for, to help make retirement and make your financial life easier so you can focus on the things that are important to you. So we're going to get ready to review some questions. I think we've got about 5 minutes left. I'm putting this up on the screen because recently we've started doing more things across the country, and more people than ever are looking us up on Facebook or Instagram or TikTok or Google. So if you haven't ever had a chance to, you could take your smartphone and just kind of scan this with your camera. You could be the first to give us a Google review because we're just starting the process of making that available. So if you want, I'll leave it on the screen. You can kind of use your phone and give a Google review. And if so, we appreciate it, because I know before I do anything, I go on Google and I look up how many stars. Like, I don't buy stuff on Amazon unless there's other people who've reviewed it. In our world, we weren't able to even ask for reviews until recently. So we're finally deciding maybe the internet's okay. So I'll leave that up there on the screen. So let's go ahead and take a look at some of the questions. If the questions are super specific, we're going to advise you that talking with someone who knows your particular situation is probably the best. But we'll see if there's some things that are going to be applicable to the group in general. So we're scrolling through. Okay. So one question was, will they back pay you if you start paying you 2 months after your requested date? Yes, absolutely. We had that happen recently. A client, the very beginning of January, they requested a January 1 start. They finally got their money sometime in March. They got a nice little lump sum. So think about that. If you backdate it 6 months, they're already 2 months behind. You're going to get 8 months of benefit all at once, which, that's a pretty big amount. So yes, they will definitely back pay you. The date you say to start your benefit is how they benchmark how much they owe you. The next question, assume Social Security retirement is up to me. I've already retired and using 401k and IRA funds. Absolutely. You are able to pick whatever paycheck for life you want. And that's all based off of when you decide to click that button and start claiming Social Security. So it says, widower, kid had a benefit until age 18, any variation with standard benefit. It is typical that children will get a benefit until at least 18, or if they go to school, there can be a bit more money that they receive unless they are disabled. For spouses, it kind of sucks. If you work, you pretty much get nothing because you can't make much until you're age 60. So yes, typically benefits for children, for spouses. When you go to ssa.gov, you can see the particulars of your situation. And I think that's a great thing to see the disability amount, survivor amounts, etc. Does Social Security retirement assume you're going to work up until you retire? Yes. So if you're going to retire at 55, your benefit statement's way wrong, because in fine print, it says, we assume you will work until 67, if that's your full retirement age amount. So again, some people think, oh, at 67, I'm going to get $3,000 a month. But if you're retiring at 55, take some money off the top, because they're looking at your best 35 years of earnings. You retired 12 years earlier than they thought you were. So the benefit numbers are going to be way off. Great question. So the first 12 months at 62 is growing elsewhere. Do the years after make up for that? So Judah, it says the first 12 months at 62 is growing elsewhere. Do the years after that make up for that? Judah, could you re-ask that for me a little bit? I'm having a dull moment. Sorry about that. Do government FERS retirees have a reduced Social Security? Maybe. So once upon a time, certain federal employees did not pay into Social Security. As such, they may have a reduced benefit. There's something called windfall elimination provision, or it's GPO or GOP. That's the government pension offset program. So it is possible that federal employees or other people with pensions could have a reduced Social Security. The more recent version of federal employee, the FERS employees, there's not going to be a reduction. They're going to have regular Social Security. So that's a really important thing to look into. If you were a teacher or some type of occupation that didn't pay into Social Security, Again, your statement might be wrong. There could be an offset where your benefits reduce based off your existing pension. Great question. Okay, if you limit earnings, if the limit of earnings is 22,000 per year, how does that affect the date you start drawing Social Security? Yeah, it's a great question. You don't want to start Social Security if you have earnings above that 22,000 if you're under full retirement age. Now, they're typically going to look at that calendar year. So you've just got to be careful to see when your big earnings stop and when you can safely claim Social Security without having it reduced. Thanks, Judah. You were saying that that the relationship between Social Security and your other investments. So yeah, you're right. If you take Social Security at 62, you're not taking from your other investments, so maybe those continue to grow. So that is a trade-off, and it comes down to risk. Do you want to take a bigger percentage draw from your portfolio, or would you feel better having more guaranteed lifetime income? It's really a balancing act. So something we can easily show different models of and just kind of put it side by side to see what sounds the best. So I think there's one last question. Downside to immediate annuities is the monthly income coming in, interest payments are coming off the original amount invested. So with immediate annuities, if you're doing an annuitization, technically part of every dollar you get is a return of principal and interest. Depending on if it's a retirement annuity or non-retirement annuity, the taxability is a little bit different. So it's a great question. There's something called the exclusion ratio. So depends on if it's non-qualified or qualified. I was talking fast because I wanted to end at 4 o'clock Pacific, and we are right at 4 o'clock Pacific. So we're going to get ready to close up the presentation. We'll stop the same way we started. And that's just by saying thank you. We appreciate you all tuning in, taking the time to chat with us, to talk about Social Security, because regardless of who you are, Social Security remains a strong, important part of a balanced retirement plan. So without any further ado, we'll send you back to the rest of your day. Appreciate your time. We hope you have a good one, and we'll look forward to seeing you on future webinars. Take care.